Welcome to Deloitte's Debrief Tax webcast series in Asia Pacific. Our webcast today is from our Global Mobility, Talent and Reward team and is titled Reward in Future of Work, Operating an Equity Plan. My name is Rebecca Lai. I'm a tax partner based in Deloitte, China. I have the pleasure of hosting today's webcast. I have three speakers with me today. Katie is a tax partner in Deloitte, Japan. Artie is a tax partner in Deloitte, India. And Tommy is a tax director in Deloitte, Australia. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. We will do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related materials, please go to the Downloads and Links box. On the other hand, mobile device user can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you can download the CPE certificate by clicking the Request CPE icon at the bottom of the webcast console. Now, let me give you an overview of the topics we want to discuss. We have three sessions today. In session 1, we'll cover Shareplan in general. In session 2, we'll bring you an APAC focus and discuss the difference in tax and legal requirements and recent updates. In session 3, we'll look at mobility in future of work and cross-border tax requirement. Without further ado, let's go to the first session. In general, traditional remuneration includes payment in cash, for example, salary and bonus, and non-cash benefits, for example, insurance coverage. Equity compensation has been increasingly used in remuneration strategy, especially for listed companies or to-be listed companies, that is startup. For the direct reason that equity compensations ties to the long-term financial goals of the company. For startups, where liquidity is tight and cash is invested in research and development, equity incentives will be offered to attract talents. So individuals can enjoy the potential upside when such an incubator becomes successful. So what are the instruments in equity compensations? Listed here are commonly used ones: share options, restricted shares unit, stock appreciation right, employee stock purchase plan. A proper equity compensation structure includes the share plan, the grant agreement, vesting and exercise conditions, and share trading restrictions. Designing the equity plan would require the study of the industry norm, local regulation requirement, implication from financial, tax, security laws, listing rules of where the shares are listed or to be potentially listed, who to be awarded, or how many to be awarded, etc. So there is no one-size-fits-all approach. We always suggest a feasibility study and analysis of the various implications during the design phase. If the design is right, it can adjust the goal to remunerate, attract and retain key talents, and the rest will be about deliver and drive. We also have to be particularly careful if the stock plans extend to subsidiaries overseas, as there may be special tax regimes or qualified plans that would allow favorable tax treatment. Hence, when drafting the plan, we need to consider country-specific appendix or exceptions. Well, we can't avoid talking about COVID since the pandemic has been with us for 2 years. There were upside trends of using equity compensation in the market, and we have seen that some companies replace pay increase with equity compensation to manage cash or fill the gap created by salary reductions. over 90% of equity compensation plans successfully received board approval last year. Equity award is still delivering a meaningful remuneration structure that aligns well with the long-term focus of the companies. Well, let me first ask Arti what you have seen in India.
Well, Rebecca, in India, stock options are still predominantly seen in the IT sector or the Deloitte startup industry. The other sectors still appear to be catching up and provide stock options to a limited segment of people, maybe high-level management staff. And what we see also is ESOPs are the most popular stock plans. We have also observed that in the last couple of years, successful startups have seen a significant amount of gain thanks to high-level acquisitions, and hence, they've made big news. So,
thanks, Arti. This also resonates with China. The fact that Chinese companies are able to offer equity incentive provides an upside to its reward strategy and has been very attractive to the talents, especially in the IT sectors. How about Australia, Tommy?
Thank you, Rebecca. I think we can say the same with Australia. Australia, being one of the early adopters in the region, has consistently seen equity offering as key to their REM strategy, and we expect this trend to continue even more in the future. So, Taiki, any thoughts on Japan?
Thanks, Tommy. Likewise, the use of equity compensation in Japan is becoming more common. These have been consistent. There has been consistent pressure from foreign investors regarding corporate governance in Japan. And in response, the corporate governance code was introduced. This effectively led to the 2016 tax reform, which allowed equity compensation, including PSUs, RS, and RSUs, to be treated as deductible expense for corporate tax purposes. And following this reform, the number of listed companies with equity compensation has more than tripled in the last 5 years in Japan. Back to you, Rebecca.
Thank you. Thank you for your insight. So now, if we look at the Shareplan life cycle, we can't underestimate its complexity. For our audiences today, most of you are finance or tax professionals, so you probably need to be involved in at least one or more of the different stages. For example, you will advise or handle tax withholding and reporting compliance, or corporate tax deductibility and recharges. While for HR, C&B, and reward, you are also taking the driver's seat in managing the equity plan, if not being exaggerated, during the entire Shareplan life cycle. Well, the Shareplan cycle is one thing, while successful Shareplan tax management is another thing. It consists of different factors. For example, a well-established data collection management system, personnel with well-versed skill to comprehend the latest legislations, and effective employee communication. Data management has been quite a challenge for a lot of organizations, especially when involving multi-jurisdictions. Shareplan administrators becomes the key, as it shall be able to capture and provide accurate and timely transaction data and feedback to the relevant stakeholders. Usually, the data is not limited to one jurisdiction, but cross-region or sometimes across the globe. Digital and advanced tools are used to generate reports for different compliance purposes and for effective communication. As reporting relies heavily on the data generated accurately, and a global service provider equipped with technical skills and access to the latest legislative update is usually appointed to handle the tax compliance. Now, this brings us to the first polling question of the day. The question is, how do you manage the tax and legal aspects of your Shareplan currently? And you have 6 choices here. While we are waiting for the result to come in, let me ask Tommy, what he's been seeing in the market?
Thanks, Rebecca. The reality is that there's no one approach that will fit or solution like what you just said. So each company solution might be different to the other. So what might work for a company may not be the ideal solution for another company. What we can observe, though, is that correlations between the appetite to try different solutions to manage their data, and in this case, exploring the use of global management system, can be largely depend on the volume of transactions as well as the readiness of such company in handling their data or database in that matter. So including things like the consistency as well as the integrity of their data. Companies with larger volume of transactions or more organized database tend to be more open to operate through a digital platform or global management system, even if there will be trial and errors along the way. And naturally, companies that are dealing with the smaller volume of transactions, they tend to stick with a more conventional way in managing their Shareplan and often use their existing in-house team rather than a dedicated team. So ideally, if you want to refer to one of the earlier slides, the balance is to strike the right synergy between your Shareplan administrator, your HR mobility function, as well as your global share or payroll function to manage such data and accordingly your global compliance in a seamless and timely manner. So in a lot of ways, similar to how you manage your global payroll, but with obviously added complexities in understanding how tax requirement in each location can be quite different, as we would later go through in the session. Now, I think the result has come in.
Yes, we have the result. Let me see. Well, other than those who do not operate the Shareplan, most of our audience will work together with the service providers using a specific global tax management system. Great. Thanks for all the responses. So now, let's go to our next session. We have looked at those which are universally applicable to operating an equity plan. Now, let's take a look at APAC. In general, places in APAC are having a tax system which is competitive or at least friendly to individual taxpayers. One would certainly be the tax rates. For example, Singapore and Hong Kong offer relatively low income tax rate. Moreover, we also have places within APAC where tax filing is less of a pain, and there are tax policies and tax system that's more consistent and predictable. While there is an increasing trend for remote work, which has been enabled by technology, it was COVID really triggered remote work to become a mainstream way of working. For example, a person can be employed in Europe and physically work remotely somewhere in Asia and enjoy the benefits of lower living costs and different lifestyle. Depending on the travel pattern, the person may or may not be subject to tax. And this certainly is a challenge of tax authorities to collect the tax if they rely on voluntary compliance. But regardless of whether the person is subject to tax or not, remote workers are welcomed because they spend money and can support economic growth, which indirectly increase tax revenue in the form of VAT or corporation tax. Most countries in Asia are also recovering relatively faster than some European countries or the US. As countries in APAC are so diverse, so now let me pass to Tommy to help us look at the differences in the tax and legal environment. Thanks, Tommy.
Thanks, Rebecca. So for our audience, what we've done here is that we prepared the next 4 slides in the form of a map of the region, where we will cover the tax and legal requirement of a Shareplan in this location to highlight the diversity of its requirement. We've also color-coded each map to make it easier to refer to the requirement, where light green indicated little to no requirement, and the color blue, depending on its depthness, indicate the level of requirement. There's also some countries that are grayed out at this point where the rules remain unclear, which we hope to cover more in the future. So we'll start from the map outlining the tax and withholding of a deferred cash incentive before we switch over to share-based award. As you can see from the map, we can expect across the board similar requirement in most jurisdictions where some form of tax withholding and reporting are expected to be met. Now, if we flip to the next slide, where we have a map outlining the tax reporting requirement of a Shareplan over the same countries, you can see some colors starting to change. And this change can also be further influenced by a number of factors. The common one being whether or not the cost of the payment of the shares are made by the local payroll. If this is the case, you can expect a heightened requirement will typically appear in the respective jurisdictions. For a country like Australia, it is also important to recognize that in addition to its federal tax requirement, there's also state tax requirement to meet. Therefore, even though you can see there is no income tax withholding requirement for the company to meet, from a state tax perspective, this may not be the case, and a level of levy is expected to be met under the state payroll tax rule in Australia. I'll switch over to Japan. Taiki, do you have any comment that you want to add?
Thank you, Tommy. For Japan, tax withholding and employer withholding obligation for a share-based incentive will really depend on whether it is a plan managed by a domestic company in Japan or a foreign parent company. Share plans managed by a domestic company in Japan is subject to withholding at source, whereas equity plans managed by foreign parent companies are not subject to withholding and requires individuals to report the income on their annual tax returns. Now, foreign plans also require employers to report the details of the equity plan to the tax office. Employer reporting is used by the tax office to catch any individuals underreporting their income. Back to you, Tommy.
Right. Thanks, Taiki. So if we flip to the next slide, which highlights the tax reporting requirement on share-based compensations, what you will observe is that countries that do not appear to operate withholding is likely to require some form of reporting instead, much like what we have talked about with Australia or Japan. Or for a country like New Zealand, there is a choice for the company to either report or to apply withholding instead on the equity compensation in agreement with the employees. Now, Arti, would you like to comment what you're seeing in India and what are the principal drivers of the tax requirement in India?
Sure, Tommy. In India, India stands at a different footing than Japan or Australia. Irrespective of the country where the plan is managed or who's bearing the cost, the employer needs to ensure payroll compliance in India for all its employees where the benefit accrues in India. And so the payroll compliances are triggered even for overseas plans that extend to employees of Indian subsidiaries. And withholding obligations continue to apply in case the sourcing period is India, even after the employee has left India, long after the employee has left India. One of the major differences between other jurisdictions and India is the mandatory valuation of shares requirement by an Indian merchant banker where the shares are not listed in India. So there are specific rules prescribed around this, and the taxes withheld and the stock incentive perquisite is to be reported in an annual remuneration statement. So this meets the employer compliance requirement. And currently, while there is no social security which is applicable for stock gains, but there is a new labor code which is slated to come in soon, and in which stock benefit would be considered as a part of wages when computing the contributions for the employees in certain cases. That's for India. And maybe we could just move on to the next slide, which talks on the security law related requirements. So if I look at security law related registrations or requirements as far as India is concerned, Indian companies that are not listed would need to comply with the Companies Act regulations, whereas listed companies would need to take care of the SEBI regulations also, which and there are new regulations which have come in 2021. So some note has to be taken on that. These regulations provide a very broad framework that the companies need to be abiding by in order to make sure that the administration is fair and everybody is at a equal footing. No rights of shareholders or employees are kind of protected, I would say, in that respect. So what do you, Tommy?
Thank you, Arti, for the thorough insight on this requirement in India. I think we can observe from the map that most countries do require some level of securities and filing the registrations. And I think this is largely due to the fact that shares are financial securities by its nature. And like most financial securities or derivatives, for that matter, there will be some level of legal compliance to be met before you can offer or grant the securities. So we also would like to quickly touch on in some jurisdictions, there will be specific exchange control requirement that companies will need to consider in the next slide when offering Shareplan to their employees. Okay, so now, as you can see, this is not the case for Australia at this point, although there is a general reporting requirement on any transaction or exchange over 10,000 Australian dollars. However, we are seeing in other locations such as China, India, and Japan, to name a few, that might be required over there. So I'll just start with Rebecca first to share what she's observing in China, and then we can focus on India and Japan next. So Rebecca, over to you.
Thanks, Tommy. So in China, we have had the very famous SAFE registration, which refers to the application of the quota for inbound or outbound remittance when Chinese nationals participate to share-based plan with share listed outside of China. This is the requirement introduced more than 10 years ago, but in recent years, we have seen some changes as announced locally. For example, Beijing SAFE required additional information when any alternation registration is submitted, while companies registered with Shanghai SAFE no longer need to submit annual filing unless there are significant changes to the plan and no longer need to apply for annual quota involving outbound remittance. Arti, what do you see in India?
India too does have exchange control regulations for subscription to overseas stock option plans. So typically, where the approval is under an automatic route, there are conditions to be met, which means that there should not be any remittances from India, and the shares offered under the stock option scheme should be by the company should be issued globally on a uniform basis. A general permission is also available for companies issuing shares to employees of subsidiaries or holding companies if the ESOP scheme has been framed under the guidelines of the SEBI or the Companies Act, and the issue of shares is within the sectorial gap of the said companies. It is pertinent to note that the employee needs to file an annual return with the central bank with details of remittances and beneficiary. And on the sale of shares that are received under the scheme, the seller, that is the employee, needs to remit the proceeds immediately or at the maximum within a period of 90 days. So Taiki, do you want to talk about what you observe in Japan?
Thank you, Arti. Usually we don't have issues with employees living in Japan, but depending on the country of residence for these employees, remitting money from Japan may be restricted under local regulations. So for example, proceeds from sale of shares in Japan may be subject to restrictions under local foreign currency regulations, as we saw in China and India. This may be not so obvious at the time share compensations are granted because no cash is involved in the initial transaction. Back to you, Tommy.
Thanks, Taiki. Now, thank you to the three of you for sharing observations. Now, with that, I'll hand over to Rebecca to take you to the other activities that we are seeing around Shareplan ecosystem in Asia Pacific, starting from the audit activity. Over to you, Rebecca.
Thanks, Tommy. Well, let me bring you some of the audit activities in China. We have seen the strengthened tax administration of equity plans For example, Shanghai Tax Authority launched a special check on tax compliance in 2020 and 2021, which covered the previous 3 years, that companies were required to submit tax filing records and the supporting details. At the moment, we have not seen further follow-up from the tax authority, while we expect the data collected could be cross-checked for identifying any discrepancies. Secondly, there was the nationwide requirement for tax registrations of equity incentive plan by end of 2021. We know the deadline to fulfill it is pretty tight, as the notice was just issued sometime in mid-October. So some companies were not able to fulfill the registration on time. Although the deadline is passed, we still encourage companies to review the existing registration status and perform the voluntary disclosure to the Tax Bureau before being audited and challenged. Lastly, we need to mention that additional module has been inserted into the tax withholding system, which require employer to submit information relating to equity incentive that will enable tax authority to draw big data for comparison and detect tax non-compliance on equity income. How about Arti in India?
Here, Rebecca, in India, one of the major causes for litigation is because of the absence of explicit sourcing provisions for taxation of stock benefit for mobile employees. So this is absent in the current Income Tax Act, and hence one has to rely on the treaty benefit. Further, as per judicial decisions, ordinary residents are taxed on global income, irrespective of whether a part of the benefit is accrued overseas for services rendered outside of India. And people have to use treaties to mitigate double taxation to some extent. And the cash flow over here becomes a little bit of a challenge. From a company or an employer point of view, the audit focus is around a corporate tax deduction for cost of stock awards. So there has been, a lot of litigation around this, and costs that are recharged by overseas entities or already for shares allotted to Indian employees, and which is reimbursed by the Indian company. That is permitted as a deduction. But again, it's necessary to kind of provide supporting documents for that. One needs to also note that over the last few years, there has been a lot of focus around reporting of foreign assets and in your tax return. So a lot of employees miss this important point where you're holding foreign shares allotted to you on account of these stock plans, but you need to just report these, and these are scrutinized pretty closely by the authorities during the audit proceedings. And this needs to be done even if there is no tax impact. So this is one of the focus areas for employees. So Taiki, would you want to highlight on what you've seen in Japan?
Thank you, RT. Share-based compensation has been on the radar for some time in Japan. And as mentioned in the previous section, share plans administered by foreign parent companies are not subject to withholding in Japan. Therefore, income taxes will be paid only when the income is reported on the individual income annual tax returns. Now, Japanese tax authorities naturally identified many cases where employees in Japan were not reporting these benefits. And to counter this, reporting requirements were introduced in 2012, effectively allowing tax authorities to capture details of foreign share-based compensation received by employees or directors of a Japanese subsidiary or branch. There was another reform in 2016, which expanded the rule to cover non-residents and former employees and directors. So their income allocable to their Japan service period is appropriately captured. Now, as you can see, the rules have developed over the years to strengthen audit activities on share-based compensation. Tommy, how is it in Australia?
Yeah, thanks, Taiki. So for Australia, we do not have or see specific audit activity as of recent on focus on income tax level that you would have seen, let's say, in China and India. There are, of course, ongoing focus in ensuring that companies and individuals alike are meeting their obligation as part of the general compliance assessment. From an income tax level similar to Japan, I guess as an extension to the data matching program that we have between company reporting and individual tax returns, any mismatches between, let's say, the two reports could lead to A2 inquiries, but it is sort of confined within that area unless, of course, we're dealing with, let's say, a higher risk situation. Now, it is probably worth highlighting that there is an area of focus on the state payroll tax side in Australia, where, again, as an extension to the data matching program, there's been increasing review that could lead to audit activity on companies' state payroll tax reporting, if, let's say, they fail to properly report the share-based compensation through their payroll tax reporting. So that's sort of our observation in Australia on audit activity. So in a nutshell, there are some activities around state payroll tax on a general level. There hasn't been that one specialized focus on the area, but they do expect people to get on board with their share filing appropriately. I think that's it for now. From my side, I'll hand it over to Rebecca.
Thank you, Tommy. So now maybe let us look at the government incentives, and I will start with China. For government incentive, we have the extension of preferential tax treatment on equity incentive from listed companies, which allow the income be taxed separately from comprehensive income of China tax residents until end of 2022. It was announced in the very last few days of 2021, but indeed good news to the concerned individuals, as equity incentive will still be subject to lower tax and remain a tax-effective remuneration item. Meanwhile, in 2018, China Securities Regulatory Commission, CSRC, announced rules allow foreign employees open A-share security accounts in China. This really provides opportunity for non-Chinese executives outside China to participate China domestically listed companies' equity incentive plan, and thus provide additional sense of belongings. This also provides opportunities for Chinese companies to compete with other international companies who would offer talent attractive incentive packages. Let me ask Heidi of what you have seen about Japan.
Thank you, Rebecca. In Japan, back in 2015, the government working group started its discussion to introduce a more flexible incentive scheme for corporate executives in Japan, in line with the newly introduced corporate governance code. The discussion led the revision of the corporate governance code 19, proposed that board remuneration should include incentives on mid to long-term business and risks associated with it in order to develop entrepreneur mindset. And as part of this decision, the 2016 tax reform allowed companies to claim deductions on share-based compensation for corporate tax purposes, which was a major change in the tax system and opened up doors to the various types of share-based compensation other than stock options. The number of listed companies with share-based compensation plan has tripled in the last 5 years. Good sign. Investor views increased stock compensation as a measure of increased confidence with the management team, and also showed improvement on corporate governance as well. Tommy, what have you seen in Australia?
Yeah, Taiki. So for Australia, on the overall tax system, there are no sort of preferential tax treatment that you would see, let's say, in China. However, what we're seeing is that there's been continuous dialogue between the industry and the governing body to improve the system through a series of tax reforms with the latest one, I think expected to come through this coming July 2022. So that's on the overall sort of a framework of the taxation system in Australia. Now, there is a bit of activity around startup. If we can just flip to the next slide. So from a startup standpoint, again, Australia has continuously tried to fine-tune its policy or framework from both the tax perspective as well as the securities law perspective. I guess with the intention to bolster and support innovative startup companies. And this can be seen by the introduction of the startup tax concession, whereby employees of a startup can either be exempt on the discount on certain shares, or in the case of rights, the deferral can be further extended until the sale of the underlying shares, as opposed to, let's say, the maturation of the award that you typically see in a more conservative plan. Now, from a security law perspective, the public disclosure requirement is also reduced for qualifying startups to limit the potential disclosure, let's say, of commercially sensitive information at that early stage where the company is still establishing its market share. So this is all done sort of in the hope to increase the competitiveness of the startup industry in Australia. Now, if we quickly, let's say, look at the startups in Southeast Asia, being the relatively younger market, we are yet to see sort of similar personal tax concession that you would see, for example, in Australia, being introduced in most part of the region. What is encouraging to see is that the rapid rise of startup industry have caught the attention of the governments, and multiverse of range of or approaches can be seen as well taken by this government to stimulate the growth of their startups. So let's say apart from a different range of tax measure or incentive for startup industry, some countries like Singapore, Philippines, and Malaysia have introduced policy in recent years where some form of government grants or financial matching commitment are provided to encourage startups. Other country, let's say, for Indonesia, for instance, focuses on its policy instead, with the recent introduction of the Omnibus Law, which is intended to improve the overall business climate in Indonesia, or in the case of startup, allow them to receive funding more easily, domestic or from overseas, or in the case of their talent, ability to access a more global talent pool. So obviously, it will be interesting to see the development of the startup ecosystem in these countries as they continue to increase the competitiveness as well of their own respective industry. So that's my observation. So I'll hand it over back to you, Rebecca.
Thanks, Tommy. Well, on startup, there are also preferential tax treatment available in China for domestic startup companies. For example, there could be a delay of payment deadline to up to 5 years, and there will be deferred taxation with a flat 20% tax rate applied if tax registration is properly performed. Let me know if you would like any more details. So for the time, maybe let me pass to Arti to talk about India.
Well, Rebecca, India does offer a possible deferment in the date of payment of taxes for employees if they're employees of eligible startups. And as you are aware, stock awards are taxed at the time of perquisite, at the time of allotment of shares. In a listed company, the employees will sell off their shares and cover for taxes, or may continue to hold the balance shares to be disposed of later. But this option is not available for employees of unlisted companies, and they must go out of pocket for payment of taxes if the shares are allotted to them, even though there may not be a cash flow or the shares itself cannot be sold. So to address this challenge, there was an amendment which was made in 2020 to provide some kind of a relief for employees of eligible startups. So these employees are allowed to defer taxes if for a point of time when the employee actually sells the shares, or he leaves the company, or for the maximum period of subsequent 4 financial years following the year of allotment. But one needs to note that this provision of deferment is only available for shares of eligible startups and not to all the unlisted companies. So there's a eligibility and an approval criteria that's envisaged here. So not kind of open to all. But this concludes the section 2 of our debrief, and let's go to section 3. So back to you, Rebecca.
Thanks, Arti. So we are now going to section 3, but before we start, here is our second polling question. And the question is, how do you manage remote work compliance in your company currently? You have 5 options. While we wait for you to respond, let me check with Arti again on what's your observation on the readiness of Indian company to address remote work compliance.
Well, Rebecca, in India, I would say it's a mixed bag. There are some companies who are, ignorant of the compliance challenges that remote work poses to them, while others have some manual and some automated tools to identify and track remote workers. Once identified, it's based on the policy of the company to see what kind of a support for compliance can be extended. But I think it's more to do with, employees kind of coming up and declaring that they're working remotely, and not an automated tracking mechanism to kind of find out, through secondary sources as to whether the employee is working within the jurisdiction or otherwise, right? So over to you.
Thank you, Arti. So how about Tommy, what you see in Australia?
Yeah, Rebecca. So I think it would be the same challenge everywhere else. Some companies are quite mature around their remote working policy, even pre-COVID, and some other companies are adapting to the requirement as we speak. Again, my view is that I'll point out the correlations that we're seeing, that companies are able to track domestic or international movements. Companies that are quite comfortable with their data and their system to handle these kind of movements. They seem to be coping relatively better, and therefore able to address the compliance need as well from a remote working perspective. Now, in the context of Australia, I think domestically, I think most companies have embarked into some form of remote working as part of the employee program much earlier than, let's say, the rest of the region. So domestically, we can expect a level of comfort there. Internationally, could be the challenge, as you are dealing with a lot more complexities, obviously around the different tax environment, and including, let's say, argument around which country have the right to source the income, or if tax treaty should be considered as well. So, and if you look at it in addition to this, some could likely extend the consideration to whether or not there is a risk to permanent establishment. If, let's say, they have employees working in other jurisdictions that different to their country of employment. So these are the things that I think company ought to consider when they think about their remote workers.
Yes, thank you, Tommy. And I know we have the result in already. Most of our audience let us know that, well, they use manual process, and it will be triggered as when they know the fact of the remote working arrangement. Again, thanks for all your responses. Okay, now let's go to our presentation part. But just echoed on the last polling question. Actually, I do want to emphasize that, well, we know before COVID, we were so used to the traditional talent deployment arrangement, such as long or short-term assignments, business travel, or permanent relocation. The pandemic has accelerated the transition to new and more flexible ways of working, such as domestic and international remote work, virtual assignments, which make employer and individual tax compliance complicated. And well, as just Tommy also shared, around the different issues. So the tax implications on equity incentive would be even more complex. Now, let me pass to Artie to go through with you the complexity with some illustrations. Thanks, Artie.
Sure, Rebecca. When issuing options to internationally mobile employees, one of the things that the employers have to deal with is double taxation in the hands of the employee. And this is because the benefit of stock awards accrues over a period of time when the two countries assert their taxing rights over the same income. However, taxation is triggered at the time of vest or exercise, so it's at a point in time. And double taxation can result in a negative employee experience and have cash flow challenges as well. The complications around double taxation are increased because of different factors, like, for example, different financial years. India follows the April to March, while many countries like to follow a calendar year for taxation. So it's a different time period as such, which the employees have to face. There could be different trigger points in different countries, depending on the local laws, whether you're taxed at grant or at vest or exercise. Then there could be categorization of income as employment income versus a capital gains, which could be different for people. And then there are tax rates, which are different. There is absence of double taxation avoidance agreements. All these kind of complex things have to be taken into account when we are dealing with taxation of people moving between different jurisdictions. Let's look at an illustration on this. And we've taken a very, very simple case here where we have an outbound employee, an Indian CFO. He's granted stock options as on 1st of April 2021, and he's working in India till December of 21, and later on he gets transferred to the US group company from 1st of January 22 for a period of 3 years. We also presume that the stock award has a 1-year vesting, so there is some vesting that happens on 31st March 22 when the person is actually in the US, serving in the US. So let's assume for the India tax perspective, this person would qualify to be a resident but not ordinary resident in India. And it's very important because residential status plays a very important role in India as compared to the situation in Japan, where the focus is on managing the plan, the company, the location of the company managing the plan, or in certain other jurisdictions, it could be that who is bearing the cost. But in India, it is the residential status which is most important. And hence this employee, let's presume him to be a resident, but not ordinary resident. And for US, he would be qualifying to be a resident because he's on a long-term assignment. So if we are looking at the vesting period of 1 year, he's been employed in India for a period of 75% of the total vesting period from grant to vest, and 25% comes is the sourcing period for the US. And since he qualifies to be a resident but not ordinary resident, between India and US, they will share the taxation benefit in terms of, say, 75% being taxed in India and 25% being taxed in US. So effectively, there is no double taxation in this example because each country chooses to tax only that part of income which is accrues and arises in their location over the sourcing period. So while on the whole, the employee would pay a tax of around 36.75%, but still there is no double taxation. This is an ideal situation. Let's tweak this example a little bit in the subsequent slide, and let's see what happens if this residential status changes to a resident and ordinary resident. So the impact for the CFO would change significantly because now India would kind of try and tax him for the whole period, that is from 1st of April to 31st of March, because he qualifies to be a resident and ordinary resident in India. So the whole of the income is going to be taxed in India, irrespective of the sourcing period. And in the US, again, he has rendered services from Jan to March period. So US is going to be taxing him on that period. So effectively what happens is the period of benefit accruing from January to March of 22 is taxed in India as well as in US. And since he qualifies to be a resident of India, in that case, and hopefully tie-breaking also to India, then India will give him a credit for the US taxes paid. And again, the effective tax would be 36.75 also in this case. But one needs to note that the incidence of tax could be increased if for some reason the foreign tax credit is denied by the India tax authorities, or it's reduced because of the calculation that takes place. Also, to claim this credit, one would need to have additional disclosures, and forms need to be filed along with the tax return. The process is rather onerous and long, and hence one needs to make sure that they have overseas tax returns available. So claiming credit is not really easy and poses a lot of challenges. And to a certain extent, we would expect the authorities to be a little bit more, what I would say, generous when applying the tax treaties here. This is something which is an expectation which is not really seen in a normal course. Going on to the subsequent slide, if we have to conclude it, what we see is that the tax analysis can become complex because it, dwells on several factors like residential status, application of the treaties, the local regulations, the legal interpretations, many other things like where the plan is managed, where the cost is cross-charged or not. All of these factors have to be taken into account, and planning ahead will definitely ease out a lot of complications for the employer as well as the employee, and rule out the possibility of penalties and interest coming up at a later stage. We have also spoken about the increased preference of companies to use equity compensation at the beginning of the section. Rebecca did highlight on that. And when companies use equity compensation to remunerate and attract and retain talent, whether it's with or without the COVID situation, this is only bound to increase because the upside of any gain to the employee is phenomenal. So while we see some employees exploring the non-traditional employment arrangements going forward, so you have contingent workers, you have gig workers, you have a lot of different types of mechanisms to attract and retain talent. How organizations could reward these workforce and whether they can offer equity incentives and balance the cost benefit for these employees has to be carefully evaluated, not only in light of the HR perspectives, but also the regulatory requirements. Thus, it's time for companies to be future ready by making sure that the information flow is managed between the jurisdictions. It's real time and it's seamless. Let me pass on to Rebecca and ask her on the nuances that she sees in China on this.
Well, Arti, thanks. While in India, it appears that the resident status of the employee is very important, so as China. So double taxation would also occur if both countries consider the individual as tax resident. So in the earliest case shared by Arti, if a Chinese domiciled individual is considered a U.S. tax resident at the same time, special arrangement need to be made for one Hong Kong and U.S. Both in calendar year basis. So we have to take into account which country would take foreign tax credit first, or which country would not be able to take any foreign tax credit claim. And there would also be monthly tax withholding in China if there is a payroll or a recharge of the cost. So much of that professional advice would necessary. Great. Now, this brings us to the last polling question of the day. And the question is, what are the topics of equity incentive plan that you would like us to cover in the future webcast? And these are multiple choices that you can pick, and you have 5 shown here. While we are waiting for the results to come in, let me ask Katie, what would be your guess that our audience would mostly pick?
Thank you, Rebecca. In Japan, just looking at the answers here, we're seeing a lot of attention on data management technology tools. So answer 2 here, probably 4 to 5 years ago, equity-based compensation was just limited to the executives of the company. But over the years, the program has really expanded to include non-executive, for example, the manager level employees or even new hires for some companies. This has really expanded the number of participants covered by the equity program, but it expanded to a more of a global program capturing people living overseas and also internationally mobile employees. Now, naturally, this has added a lot of complexity in terms of tax and legal rules. So companies are more exposed to comply with foreign tax and legal requirements, which often we're not familiar with. And manual handling of to meet these compliance needs has really become a big challenge. Hence, there's a need to look for a digital solution in the Japanese market. And this is what we are hearing from our counterparts here. But again, depending on the size of the program and the maturity of the program, still majority of the companies here in Japan are trying to manage the program manually. However, by making sure there's a clear roles and responsibility laid out for each of the payroll or the HR, the stock administrators in Japan and also countries overseas. Okay, I think we have the results now. Back to you, Rebecca.
Yes, thank you. We do see the result. Wow. Yeah, I think, most of the audience select the pitfall in designing and operating equity plan, while industry-specific details are the second mostly selected choices. Thanks again for all of your responses. All right. Now, we would like to share with you some examples of how Deloitte can assist you as our client in this end-to-end share plan life cycle. Maybe I will invite Tommy to go first. Tommy, please.
Thanks, Rebecca. I think this slide do give a good picture of how things should be managed in a sequence of flow. So, and that's how typically we assist our clients as well. So if you look at it, we tend to talk about the design first. So try to understand the company objectives, and obviously in that we select the instrument or the vehicle to ensure that the objective can be met. That's probably where most of the activities will happen around the design. And also in selecting that instrument, we will talk about how effective that will be, again, with the same goal to make sure that the objective can be met. So once we've got past that stage where the brainstorming happened and the straw man has been designed, then typically that's where we start putting letters to the papers, right? We'll bring the team that we typically work with. Typically, we do work with, let's say, in the case of Deloitte in Australia, we work quite closely with the Deloitte legal team. So we'll bring in our Shareplan legal practitioner to come on board, and we start drafting the plan to make sure that what's the client have considered can also be well represented in the plan itself. So that's typically how we also make sure that we bring the best of Deloitte to our clients. Then once you have the plans and you talk about what you want to do, then typically all the action points need to be ticked off as well. From a tax perspective, from a legal perspective, making sure all the things that we have covered in the sessions are met as well. Through, let's say, either you use a manual tool like what I have just mentioned, or if you are more ready and you are quite comfortable to use a global assistant, then some companies will actually start to look at a global solution. So and the same manner that we've done as well. So Deloitte, we created, currently there's one global platform around withholding solutions, where if you're operating in cross-border jurisdictions and typically in the countries that do expect withholding, as a company, from a company perspective, you do want to meet those requirements in a timely manner. So when you have the data ready, typically we work with a global solution to ensure that all these global compliance can be met in a relatively swift fashion. So I do think that this picture here do explain quite well typically how things are being managed and how we fit in within the client needs. So yeah, that's I guess from my side. Now, Ati, do you have anything that you want to add to this that what you've seen?
Well, I would. I'm with you, Tommy. This is what we see. But one of the typical areas which happen in case of more mature companies is where they already have plans for several years, and it extends globally. And over a point in time, as more and more employees start being eligible for options, there are a lot of gaps that appear in either reporting, in either compliance between jurisdictions, cross charges. There is always a change in law in some country or the other, and what we see is over a point in time, people really companies don't get the whole picture or holistic view of things. So maybe what would be good is to have a regular audit or a health check to just avoid any kind of challenges for any particular jurisdictions. Also, this is more in case there are global plans extending to several jurisdictions. So Taiki, over to you.
Thanks, Arti. Just conscious of time. Again, from a Japan perspective, this is a very good example of where Deloitte can offer a real end-to-end solution, teaming up with our legal team and also our human capital team. From a tax perspective, we work with the corporate business tax team to make sure things are covered from start to end. So maybe back to you, Rebecca, for the closing.
Yes, thanks. Well, just maybe the very last point I would like to say is to highlight effective employee communication is very important, as reward is in the eye of the recipient. So we assist companies to develop a tailored communication strategy to get the buy-in from the employees, which Stitch, that is part of our Deloitte business, has done a fantastic job on the design, the touch, and the messages. So please contact us if you want to hear more about Stitch. Well, thanks Kati, Arti, and Tommy for your extensive sharing and insights today. This really brings us to the end of our today's discussion. Well, we have seen a lot of questions coming in, but we will have to come back to you on this, as this is all we have time for. Special thanks to all of you who were able to join us. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's webcast. If you joined us late, this presentation will be archived for future viewing. If you feel that others would also benefit from this webcast, please share the webcast through the Share This icon or have them visit the debrief website. We'll respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other questions or comments later, reach out either to me or our speakers. We'll be more than happy to talk to you. And please don't forget to tune in to our next scheduled webcast from the Geographic Updates on March 1st, titled 2022 Japan Tax Reforms Proposals, Pursuit of Post-Pandemic Priorities. At last, from all of us at Deloitte, thank you for your participation in Deloitte's Asia Pacific Tax webcast today. Goodbye.